Meantime, it's the last trading day of April. It's been a wild month, as you know. Our next guest makes the case for stocks, the European kind. Jeffrey Kleintop joins us today, Charles Schwab, Chief Global Investment Strategist. Great to have you back, Jeffrey. Thanks for being with us.
Thanks for having me on.
So we did get their GDP number as well in the Eurozone. It was a positive 0.4. You think there's more runway on that trade?
Yeah, and that's the data that should be getting more attention this morning. That better than expected 0.4 with inflation in Europe running at just 2.2%. The ECB is likely to cut 2 or 3 more times this year, and that combination of fiscal stimulus in the form of tax cuts this year and spending growth in Europe, along with those rate cuts, we haven't seen that in Europe in nearly a generation, not since the 2000s. And that's helping drive Europe's stock market to outperform the S&P 500 this year by more than 20% year to date, echoing that outperformance we saw back in the 2000s.
How much compression do you think there can be between a European multiple and our own?
Well, that's interesting because, look, the U.S. multiple has been really, really elevated, and Europe has gone through 2 years of a rolling recession where the manufacturing downturn in the global economy really weighed much more heavily on the Europe than it did in the U.S., where we're more service-oriented. That's now coming back together. I'd look at 2 companies that do similar things, Coca-Cola and Nestle. Nestle, a European company, Coke in the U.S. I don't have a view on either company or from a stock perspective, but Coke trades at 25 times earnings. Nestle trades at 18. I think that gap narrows along with other European multiples as they rise from below average multiples and U.S. multiples come down.
What's your view then on U.S. equities?
Well, I think we've got some challenges here. Look, you've got a supply shock for U.S. companies, and that's harder to deal with than a demand shock. It's easier to replace lost demand, and that's what other companies are dealing with around the world, the loss of demand from the U.S. But in the U.S., we're trying to deal with the potential supply shock here in Q2, and that's one of the reasons why U.S. earnings revisions are coming down like we saw during the global financial crisis and the pandemic, but not true outside the U.S., where earnings remain fairly resilient, and that's, again, another reason why we're seeing outperformance here by international equities.
Do you think we're at a point now where if there is, Deutsche is using the phrase relenting on tariff policy, if we were to undo or unwind or reverse a lot of this, is there time to save sort of the macro effects?
There may be, but look, the damage is done with regard to the uncertainty. So even if we reverse, we know that the president has, the ability to shift right back again. And so I think there's going to be a lingering uncertainty here and not a lot of trust when it comes to investing in the U.S. and committing to dollar-based assets. And so I think this rotation to international is likely to continue.
I don't know. Treasuries are back in demand. They're rallying today off the soft data, which is normal to see. Jeff, right? And there's now maybe increased hope that as we get weak data, we'll move closer to a Fed cut, and that could be good for U.S. stocks.
It's possible that we see some of the worst case scenarios coming off the table, and maybe there are some deals coming together between the U.S. and a few other nations. But I think in terms of actual growth momentum, we've already seen the stimulus being put in place in Germany, for example. Already seeing European defense stocks become the new Mag 7, right? Those 7 defense stocks in Europe are up 33% this year compared to the U.S. Mag 7. Already we've got this momentum shift taking place beneath the surface, along with, as we mentioned, more attractive valuations. I think that keeps momentum in Europe here in the second quarter, along with the rest of the year.
A lot of charts today looking at the first 100 days, and S&P, NASDAQ, Mag 7, the only things that traded worse in the first 100 days were Brent and WTI. You could have bought anything else, gold, copper, China, high yield, investment grade, European, you would have done better. Do you think S&P, NASDAQ, Mag 7 can climb in that spectrum in the next 100 days?
I think look, a lot of them are liquidity reserves, right? So if you do get the more optimism around Fed rate cuts, you could see money come back into those parts of the market. But we like financials. We like sectors that are more domestically exposed, for example, within Europe. Look, you've got European companies with more domestic sales, less exposed to the U.S., less exposed to things like energy, global sectors, are doing much better. They're up 30% year to date. So the more domestically focused outside the U.S., the better those companies are doing. Financials leading the way.
Yeah, sort of brings us back to what Lagarde told Sarah the other day, is that the EU's most important trade partner is the EU.
Yeah, absolutely.
Jeffrey,
and that, we continue to see that. I think we continue to see that, and that's one of the reasons why I think we're going to continue to see more resilient earnings within the European space. That's what's key here, setting aside the economic data this morning.
Jeffrey, what a day between the corporate earnings flow and the macro data. Really appreciate some insight. Thanks.